Hello, I'm David Hicks of the Alliance Legal Group. There has been a great deal of discussion regarding the recent mortgage fraud settlement. The signatories to the deal are Bank of America, Citibank, Wells Fargo, JP Morgan Chase, and Ally Financial, formerly GMAC, which handle payments on more than half of the nation's outstanding 27 million home loans and therefore have been at the center of the servicing and foreclosure abuses the settlement is supposed to end. The activity at the heart of this settlement is what we call robo-signing, the massive, systematic, fraudulent, and criminal conduct engaged in by our nation's largest lenders. This is where banks themselves or their contractors sign legal documents to file in court, swearing under oath that the facts are true, and therefore support the legal application to take someone's home away from them, in other words, foreclose. As reported, the settlement is going to be $25 billion, with only $5 billion in cash and $20 billion in loan forgiveness. It calls for much more money for loan modifications than HAMP has cost so far, and it could mean money or relief for close to 2 million current and former homeowners. The loan modifications could yield tens of billions in principal reduction for 1 million homeowners, but that's a sliver compared with the 11 million homeowners today who are over $700 billion underwater. And the cash compensation of $1,500 to $2,000 for up to 1 million people who lost their homes will hardly make them whole. Most of the balance is in the mortgage relief for stressed or underwater mortgage holders, including principal reductions. Being delinquent on your loan is a disqualification for refinancing, but is almost a requirement for getting a principal reduction. The largest piece of the robo-signing settlement is for principal reduction for borrowers who are either delinquent or at imminent risk of default. This is opposite of the refinancing rules laid out in HARP and the State of the Union address, which requires borrowers to be current on their payments because that shows they're responsible. So much for a coherent message from the government to homeowners about how to go about getting help. The banks engaged in years-long pattern and practice of what can only be described as fraudulent, if not criminal conduct that would put anyone else in prison for years, if not decades. Yet banks get to buy their way out by providing some help to just a few of the victims they created. The settlement discussions are the same. Eliminate all or almost all liability for the bank, and most importantly, all bank officers and employees in exchange for a loan forgiveness or modification program. If you don't listen too closely, it sounds as if they're putting up the $25 billion themselves. Not so. The only cold cash the banks are paying is a combined $5 billion, including $1.5 billion to compensate borrowers whose homes were foreclosed on from 2008 through the end of last year, with the rest going to the federal and state governments to pay for regulatory programs. Supposedly a big part of the deal is the implementation of new foreclosure standards to end the abuses that made the deal necessary. These standards require banks seeking to foreclose henceforth to submit sworn affidavits that are accurate about the amounts owed and the legal right of the servicer to proceed, and require the bank officers who sign them to actually examine the documents they swear to have examined. The payoff is a minuscule fraction of the cost these practices have imposed on borrowers, the court system, and the economy. It may not be long before the euphoria over the settlement evaporates in the realization that the banks that made a travesty of the mortgage market are still getting a pass.